All right, stocks are attempting a rebound today after 4 straight days of losses on the S&P 500 as markets have tried to come to grips with a repricing of expectations for the Federal Reserve. So on that note, let's get back to our question of the day. Are the hawks now priced in? Mark Connors, head of research at 3IQ Corp, joins us now for more. So Mark, what do you think?
Hey, Kaylee. Yeah, I think the hawks are priced in. We look at the volatility structure right now as focusing more on rates. The VIX is like a Twinkie. It's appealing at first. It provides no nutritional value. For the last 10 years, you really had to look at the MOVE index. And when that popped, equities retreated. So we see right now there's going to be a decline in this equity kind of bounce. You know, we had February being a big sell-off since that February 3rd unemployment number. But our indicator, which was the S&P versus U.S. 10-year correlation, it's so simple. It's not that complex. Our team, and I've used it since 2007, and it reversed February 2nd before the February 3rd release. So are the hawks priced in? I would say that they're 80% priced in. I'll put that number out there. I think there's still some movement. When you have euro dollars move 1 point across the curve in 2 weeks, you know, I still think there's some digestion about what exactly happened in February with unemployment.
Mark, good morning. It's Guy. We continue to chase the data, though. The data continues to confound all of us. It continues to confound the Fed. It continues to confound, it seems, all central banks. The data continue to hold up. We've just seen data today out of the United States on claims. You've got inflation data out today as well on the quarterly basis. We're going to get more of that tomorrow. The Fed is struggling to have an impact here. Therefore, it's going to have to go further. So, yeah, the hawks may be priced in for now. Do you think the hawks are ultimately going to have to go harder, fly higher?
Guy, I like you hold my feet to the fire because you're right that if you were just to look at euro dollars, they're going to be so variable. So let's take a step back. We've talked about inflation only when Russia invaded Ukraine. That we've had asset inflation for a decade. But when it hit our kitchen table, our gas tank, and our HVAC systems, and all of a sudden discretionary income went down, that's when it became a problem. So I mention that because going back to your question about do we chase the data? No. There's a structural change. We are going to have debasement of fiat, period, going forward at a higher rate than we've had in the prior 50 years. That's structurally there. So what are people doing? Look at Ira Jersey. This morning, he's like, forget 2s, 10s. It doesn't hurt banks anymore because they're all front-end loaded with their assets. So businesses are changing. That's why Walmart can hire, because they're adapting with technology to the higher structural inflation. So that's my 5 cents. You have to look at You have to change your behavior, and those who do it will win.
Okay, so Mark, if we're talking about structural changes, does that also mean returns in the equity market are just going to be structurally lower going forward because we now live in a different world? Yes,
we are in a third regime. Howard Marks talked about it a bit. Instead of zero rates, which we have a measure, GDP versus the Wilshire 5000, just to say, hey, shouldn't they be related? And they were. For 40 years, from 71 to 2010, they ranged between like 0.7 and 1. Like GDP was 16 trillion in 2010. The Wilshire 5000 was 16 trillion. But that ratio almost hit 2.5 times last year. Yep. So equities are not going to have the same type of buy dip. We're not going to have, PE ratios at 30 in the near term. But they are a better store of value than the front end of the curve. And I think that we are going to have rates go into that 2 to 4% as a long term because there are growth headwinds. So we have two economies. We have the real economy, which is slow, and we have the financial and hard asset economy, which is just still very persistent and is where investments should be, I think.
So in terms of rebalancing those, what happens? You talked about the Wilshire versus GDP. If we're going to rebalance back to something that is more consistent with the long-term trend, Mark, what happens here? Does GDP come up? That looks like it's going to be a struggle right now, but I guess on a nominal basis with inflation doing what it's doing, maybe it will. Do asset prices just go sideways? How does the ratio realign?
Right now, you need to have dry powder, and I forgot who the woman you had on just before, Hunt, I think, spoke about putting 5%, getting that 5% front end duration while you wait. I think we're in a certain, everyone said we're in an uncertain. The data doesn't help. We don't know what's going on. We haven't had inflation. So get paid 5% with whatever, 20, 25% of your portfolio. You still need to have a house, hopefully. You need to be in the equity market. But you need to pull money to the front end because we don't know where we're going right now.
And Mark, finally, we just have about 30 seconds left, but there's been some back and forth over the last week or so on the possibility of a Volmageddon 2.0. What do you see?
Not in the equity market. We've been popped 3 or 4 times with COVID, starting on like March 17th when you had the Treasury market almost go kerplooey. And we've had the PE taken down. So if there's a Volmageddon, I think it's more in rates or credit. So no Volmageddon. I think you had someone on earlier saying that raise to the third power. No, but look at rates. And look at Treasury volatility. I'll leave the last part. The money supply has doubled its volatility from a trailing 50-year average. That's something that's worrisome.
Mark, we're going to wrap it up there. Great to catch up. Nice to see you in Canada. Thank you very much indeed. Mark Connors, Head of Research at 3iQ Core.